Berkshire Hathaway reported $90 billion in net income in 2021. That number flipped to a $23 billion loss in 2022. Then it rebounded to a $96 billion profit in 2023. You might be thinking that 2022 was an anomaly, but you'd be wrong. Berkshire Hathaway's net income has gyrated wildly ever since 2017. Now, Warren Buffett is aware of this profit volatility, and he recently warned investors that the company's net income is a worse than useless figure in his 2023 letter to shareholders. Why did Buffett say that? And why has Berkshire's profits become so volatile? In this video, I'll explain everything you need to know in less than 10 minutes. Hi, my name is Brian Feraldi. I'm a financial educator who's been analyzing and investing in businesses for more than 20 years. Let's get started. Now, there are three primary reasons why a company's net income can become a worse than useless figure. Reason number one relates to unrealized gains and losses. Now, this problem stems from an accounting change that occurred in 2018 related to how a company books unrealized gains and losses on its income statement. If you follow Warren Buffett, you know that Berkshire Hathaway holds a significant amount of stock in other publicly traded companies. In fact, this figure was more than $350 billion at the end of 2023. These include multi-billion-dollar positions in companies like Apple, Bank of America, American Express, and more. Now, this wasn't a problem for Berkshire Hathaway until 2016. That's when a new accounting rule was approved, and this new rule said that unrealized gains and losses on holdings needed to be included in the company's income statement, and that rule went into effect a few years later. What this means is that Berkshire now has to report a profit or loss on its stock investment regardless of whether the company sold them or not. Now, this accounting change alone is leading to huge fluctuations in Berkshire Hathaway's reported net income that does not accurately reflect the company's underlying performance. Now, if you do some digging, you can see whether or not the company actually sold those investments by digging into the company's cash flow statement, but that information won't be readily available on the company's net income statement. Now, you might be thinking that this is only a problem specifically for Berkshire Hathaway, but you'd be wrong. Many publicly traded companies own stock in other businesses, and that can make their net income worthless too. For example, take a look at Shopify's net income. You notice how wild it became in 2021 and 2022? Well, that's because of this problem. See, Shopify has an equity position in a company called Affirm. When Affirm became a publicly traded company in 2021, Shopify had to report its equity position in Affirm as a profit. However, when Affirm stock fell drastically in 2022, Shopify had then to mark down that position as a loss. Now, in both cases, Shopify didn't sell, but since it had to report a gain on the investment in 2021 and a loss on the investment in 2022, but what you can see in this chart is that the vast majority of Shopify's quote-unquote net income actually stems from the gain or losses on this Affirm stock. Now, this also affects Amazon, which owns a sizable equity position in Rivian. So now, as goes Rivian's stock, goes Amazon's profits. Now, that accounting change alone can make a company's earnings a worse than useless figure. But that brings us to reason number two why earnings can be so deceiving, and that relates to earnings manipulation. Now, a company's earnings can be manipulated in both directions for both good and bad reasons. When this happens, a company's earnings can become a useless figure for investors since it shows the company is either over-earning or under-earning its true potential. For example, in 2018, Starbucks reported a huge jump in its net income. You would naturally think that the company just had a great year of selling coffee, but you would be wrong. What actually happened is Starbucks struck up a joint venture deal with Nestle related to its consumer packaged goods. That deal brought in a $1.4 billion payment to Starbucks, which Starbucks was forced to add to its net income. Now, Starbucks wasn't trying to deceive its investors in this case, it was just reporting this one-off transaction. But this shows how a company's net income can be manipulated on accident if you weren't paying attention from these one-time events. Now, a company can manipulate its revenue in a few ways. One is by recognizing revenue before it's earned. Another way would be pushing excess products onto distributors to inflate sales figures, which is called channel stuffing. A company can also manipulate its expenses both up and down. It can do so by capitalizing expenses, which spreads out their costs over several periods, or it can change its depreciation and amortization practices, which can move its costs up or down depending on what management wants. A company can also play with its reserves, which helps it to overstate expenses, or it can release reserves, which understates the company's current expenses. Now, Buffett has even said that he could easily manipulate Berkshire Hathaway's net income legally to show almost any number he wanted. Now, Buffett is obviously extremely ethical, so he has no reason to do so, but you can imagine how tempting it can be to manipulate earnings. Company executives can literally make millions of dollars from manipulating their earnings to either earn bonuses or sell their stock at an artificially inflated price. We've seen this happen numerous times in recent years. For example, in 2018, Memetics Group inflated the company's earnings by changing its revenue recognition practices. Or Wirecard, the German payment processor, falsely reported $1.9 billion in cash balances in 2020. Or finally, Luckin Coffin was found to have fabricated its sales figures in 2020, which overstated its revenue by more than $300 million. Now that brings us to factor number 3, why a company's earnings can be a worse than useless figure, and that relates to external factors. There are a number of external factors that companies have no control over that can move their company's earnings up or down. For example, the government can make changes to taxes, regulations, or tariffs that can significantly impact the company's profits. Or a company can be subject to market forces, and things like interest rates, currency rates, or commodity prices can significantly impact the company's profits. Or a company simply might be in a boom or bust industry, where demand for the company's products is cyclical and can rise or fall drastically based on market changes. Over the last few years, Apple's profits have been dramatically impacted by changes in currency movements since it does so much business outside the US. Or in 2018, companies like Ford were significantly impacted by new tariffs that were caused on steel and aluminum. Or in 2020, Netflix's profits were significantly impacted by changes to international tax laws, which resulted in a higher tax bill for the company. Now, what can investors do about this earnings problem? Well, Buffett told us exactly what to do in his 2023 letter to shareholders. Buffett stated that a company's earnings should be used only as a starting point to evaluating the business. Now, for Berkshire Hathaway in particular, he suggests that investors focus on the company's operating earnings, which the company also reports, and tell a smoothed out picture of the company's actual profit generation capabilities. Now, this same logic can apply to almost any business whose earnings might be impacted by one of the 3 categories I highlighted earlier in this video. For example, take a company like Amazon. We know that Amazon's net income is now significantly impacted by Rivian's stock price, which makes its net income a worse than useless figure. However, if we look at the company's operating income again, we can say far more predictability, and this is a better measure of the company's profit generation capabilities than its net income. Now, Buffett also suggests a number of other financial metrics that you can use to judge a company's earnings power. This could include things like gross margin, return on equity, owner's earnings, and even free cash flow. Now, I made a simple PDF that has all of Warren Buffett's favorite financial numbers on them, and if you want a free copy of that PDF, just visit longtermmindset.co/Buffett or click the link in the video description and I'll send you a free copy. Thanks for watching this video, and if you liked it, please give us the thumbs up. It really helps us out on YouTube, and let me know in the comments section if you want to see more videos like this. Meanwhile, if you want to go deeper into financial statements, I highly recommend you watch this video next.